You spent decades building your wealth. Your retirement accounts look strong, your investments are solid, and on paper you should be set for life. But there's one critical issue that catches many retirees off guard: the retirement income gap. This is the period where your expenses remain high, but your income sources haven't fully kicked in yet. Or worse, they're taxable in ways you didn't anticipate. If you're not prepared for it, the gap can erode your wealth faster than you ever expected. Most advisors don't talk about this because it's not about picking the right mutual funds or chasing higher return. It's about strategic planning to align your cash flow, taxes, and lifestyle in retirement. I'm Ryan Glasgow, founder of Glasgow Investment Solution. For over 20 years, I've worked with real estate investors, high net worth individuals, and business owners across the country to create customized strategies for building and preserving wealth, especially through tax-efficient retirement planning, 1031 exchanges, and alternative investment. If you're looking for ways to grow your wealth while mitigating taxes, enhancing returns, and reducing risk, this channel is built for you. Comment, like, and subscribe to stay informed about smarter retirement and tax planning strategies. On paper, your retirement plan might look solid. You've saved diligently over the years, your 401k, IRAs, and brokerage accounts show a healthy balance. Maybe you even have rental properties or a business that generates income. But here's what most investors don't see coming: the retirement income gap. This gap often shows up in the first phase of retirement, between the time you stop working and the time guaranteed income sources like Social Security or pensions kick in. Here's how it plays out. You still have higher expenses due to travel, healthcare, helping kids or grandkids, and you need cash flow to cover them. At the same time, you may have retired at 62, but wanted to delay Social Security to get a larger benefit. Or maybe you're retired in your late 50s, but your pension doesn't kick in for several years. Perhaps you stop working because an inheritance is coming, but you don't know the exact timing. In a scenario like one of these, many retirees begin pulling large sums from their pre-tax retirement accounts, such as IRAs and 401ks. And this is where the problems begin. Those withdrawals can push you into a higher tax bracket than expected. They can cause up to 85% of your Social Security income to be taxable, once you start taking it, of course. And they can also trigger higher Medicare premiums because of IRMA surcharges. This is a silent wealth erode. The truth is, you probably never thought of this because most advisors don't bring it up. Many are focused on how much you saved, which is the base of their fee income, and they simply calculate a 4% withdrawal rate over time. And that financial plan you paid thousands for a few years ago, it rarely, if ever, gets revisited. Instead of actual forward-looking planning, you hear tired statements from ancient doctrines such as delay Social Security as long as possible and keep your investments growing, but pull from them only when necessary. This advice misses the bigger picture. True financial planning encompasses how you'll strategically use those savings over time. You must account for retired minimum distributions, or RMDs. Starting at age 73, the IRS forces you to withdraw from pre-tax accounts whether you need the money or not. This can cause an income spike that increases your taxes and reduces your flexibility. Sequence of returns risk. If you withdraw heavily during a market downturn early in retirement, it locks in losses and makes it harder for your portfolio to recover, if ever. Tax bracket creep. Large withdrawals early on can push you into a higher tax bracket and increase taxes on other income sources. This is why high net worth investors need a forward-looking strategy, not just a withdrawal plan. The wealthiest retirees approach the income gap differently. They don't wait until retirement to figure it out. They plan years in advance. Here's what they do. One is tax diversification. They build a mix of account types: pre-tax, like IRAs, Roth accounts, and taxable brokerage accounts. This gives them flexibility to draw income in a way that keeps their taxable income in check. The second option is Roth conversions during the gap years. Between retirement and age 73, when RMDs kick in, there's often a window where income is lower. The wealthy use this time to gradually move money from pre-tax accounts into Roth IRAs. This means paying taxes now at lower rates and enjoying tax-free withdrawals later. Alternative income streams are another example. For real estate investors, strategies like Delaware Statutory Trust, or DSTs, allow them to exchange appreciated properties into professionally managed passive investments that generate monthly income. This is all without triggering a massive tax bill from selling it outright. You can also incorporate private and/or alternative investments. Although these investments have less liquidity, they often have tax advantages and higher distributions than their trading counterparts. Lastly, you need to coordinate Social Security type. Instead of defaulting to early or late claiming, you need to consider how Social Security fits into your overall tax picture. Sometimes starting earlier fills the gap, other times delaying and pairing with a Roth conversion creates better long-term results. This isn't about avoiding taxes, it's about controlling when and how you pay them to maximize your lifetime after-tax income. Timing is critical. The earlier you address the retirement income gap, the more options you have. Here's an example. A couple retired at 60 with $4 million in retirement accounts. They wanted to delay Social Security until 70, but they hadn't thought about how to bridge that 10-year gap. A custom strategy consists of using brokerage account investments for its retirement assets to cover the first years, in which $95,000 per year was converted from traditional IRAs to Roths and kept them in a 12% bracket. By the time they hit 73, their RMDs were far smaller because much of the money had already been moved into Roth accounts. The result? They saved several $100,000 in projected lifetime taxes. They reduced Medicare surcharges, and they now have a predictable stream of tax-free income to supplement their taxable income in retirement. Contrast out the clients who wait too long. By age 73, many RMDs alone push retirees into higher tax brackets with fewer options to manage their income. Timing is everything. The decisions you make in the first 5 years of retirement can shape your tax picture for decades to come. It is something that investors should discuss with a financial planner 5 to 10 years before retirement. Most people don't, and it just isn't something most people see come. On the surface, it feels like you've done everything right. You saved diligently, invested wisely, built a strong financial foundation. But retirement isn't just about how much you've accumulated. It's about how you turn that wealth into income in a way that's sustainable, tax efficient, and aligned with the lifestyle you want. If you don't plan for the gap, the years between leaving your career and fully turning on other income sources like Social Security or pensions, you're at risk of creating unintended tax consequences. You could end up with higher Medicare premiums, larger RMDs, and a lifetime tax bill far bigger than necessary. The truth is, closing this gap isn't about making one big decision. It's about a series of small strategic moves: timing withdrawals, managing your tax brackets, coordinating Social Security, and ensuring your investments support your goals. This is why the wealthiest investors don't leave this to chance. They work with experienced advisors to build forward-looking income plans that minimize taxes and maximizes flexibility, not just for their retirement, but for the legacy they'll leave behind. If you're thinking about retirement, or if you're already retired and wondering how to avoid the tax traps most advisors don't talk about, I invite you to schedule a call with me using the link in the description below. We'll talk through your goals, your timeline, and your unique financial picture. Together, we'll create a customized strategy that helps you close your income gap, reduce unnecessary taxes, and simplify your financial life so you can enjoy the retirement you worked so hard to build. Don't wait until the gap shows up to take action. The earlier you plan, the more options you have to protect and grow your wealth on your terms.